Welcome, and I should say welcome back, Bahay, from Parkway Corporate. It's been quite a number of months, if not say half a year or so, that we've had our last interview together, and a lot of things have happened. Mostly, investors were forced to follow the quarterly reports, which are always very informative. Except for the latest really great achievement that was a news release in itself, which was a feasibility awarded by Shell of all companies. Shell that operates coal seam methane operations in Queensland. So I think we should try and really wrap it up what happened over this last 6 months on the operation side, which seems to be thriving and growing, but also on the disruptive technology that ultimately is the core business of I could consider the core business of Parkway. So with that, I'll hand over the baton to you. And what is really the driver right now for the company, and what do you see to be the driver in the next couple of months?
Good morning, Sven, and thanks for having us having me back on the show. It has been a terribly busy time at Parkway. I think it has been 6 months or so, as you say. So you're right. There are essentially two parts to our business. There's the technology part of our business, and I think you're right. That is the most prospective part of our business. It's highly disruptive technology addressing large global markets. So most definitely, that's our priority. That's where we see the opportunities. On the same note, we can't sit around trying to convince people that our technology is great. We should be embedding ourselves in industry, sorting out a whole range of water treatment related challenges. I think that's an important part of being able to get in front of customers, be part of the solution. So over the course of the last 6 months, we've been very active in making progress in that regard. And as you would have noted from the quarterly, Sven, we're progressively increasing our activities, our revenue streams from conventional water treatment part of our business. Yes. All the while, the technology part of the business has been growing in the background. So partnerships, new technologies, piloting programs, which is a very long sort of gestation period. It can take quite a period of time to go through from an interesting technology, some preliminary test results, through to something that really generates some traction. And fortunately, we've been through this process before, myself in a range of different companies. So we've, I think, done a good job in assembling a portfolio of technologies. So they have different markets, different risk profiles, different stage of development to really give us that critical mass, I guess, to be able to have that constant news flow rather than betting the company on a single technology and hoping for the best. Yep. Yeah.
Okay. So just one step back. This is a water treatment company. You turn it into a water treatment company. Previously had a different background. And sometimes really there's so many special, let's say, items and technology items that it's sometimes a little almost confusing. So just if you allow, my understanding is that currently you are apparently having or building or almost starting to operate two different pilot plants for two different let's say legs of this disruptive technology. One is a pre-treatment IBC technology, and then the other one is the let's say main technology, I would call it, which is the cleanup and the extraction basically side. Is that understanding correct? First of all.
We do have two core innovative technologies, AIMS being a technology for processing complex solutions, including brines.
Yes.
And the IBC technology is suitable for pre-treating some of those brines, but they I guess the distinction I should make is they both have very large addressable markets, and in their own right, they're made up of sort of a portfolio of applications. So very, very diverse applications, and there are instances where it makes sense to be able to bring those technologies together to form an integrated flow sheet. But I guess if we sort of step back to what we're building an industrial water treatment company at Parkway.
Yes.
We have these two predominant innovative technologies that we've been developing, scaling up, piloting for a long time. And I think you alluded to it earlier. The feasibility study that we were awarded with Shell, I think, is a critical moment because it really sort of highlights the recognition that these problems are so large, so complicated, that really the majors are genuinely looking for next generation technologies to really make their operations more sustainable. And for us, we feel, this is a very strong recognition that, we have a technology that genuinely is, genuinely is innovative, is disruptive, and really has the potential to make these operations far more sustainable. So that's a little bit of market recognition there.
Well, and the opportunity, according again to the quarterly report, is massive. I don't think that has necessarily been fully recognized by the market yet. The sheer size of the opportunity, which is just one out of probably many to follow if this was to be successful. And we need to talk about how deeply you are into this process. I remember we talked about it at another occasion where you said the relationship with Shell dates back 2 years. It's not something that occurred just overnight and came because they're so explorative. They really they know exactly what they're dealing with when they engaged you. So yeah. The size of the opportunity, it's just amazing.
Yeah, look, it is. We've been very, obviously our collaboration with Shell is governed by, quite detailed confidentiality type arrangements, understandably. And as is normally the case, these are often waste streams. They're quite significant in size. They represent potential risks. So as you would expect, large companies are generally quite, averse, don't necessarily want to sort of draw too much attention to these things. Not necessarily a case of anything to hide, but it's just, not exactly front page of the annual report type sort of material. I guess from a Parkway perspective, yes, we have great relationships with many large companies, and the opportunity for coal seam gas in Queensland in particular, this is an industry that's been around for about a decade. So involves producing gas from coal seams, and in this case, exporting much of that gas to international LNG markets. And that's a highly profitable industry. But in order to be able to do that, they have to dewater these coal seams, so remove the water, which is a very significant environmental legacy. And it's a market we've been operating in for many years, investigating a range of different technologies. And the industry itself has spent more than $100 million over the last decade trying new technologies to find a solution, and unsuccessfully, I might add. And I guess to sort of summarize the opportunity, this is a captive market in that the estimates we put out recently assessing the annual cost of treating that wastewater in the order of hundreds of millions of dollars. We think our $300 million estimate ultimately is conservative. So this is a large addressable market. The second point to sort of add, Sven, is this is a highly regulated environment. So the operating permits for all of those operators are directly linked to being able to assess treatment technologies for that wastewater. And if there's a viable, technically viable, economically feasible alternative, they are obligated to adopt that technology. So this is a large, regulated sort of captive market. And from our perspective, the largest dominant player in that market by a long shot is Shell. They operate QGC operation, which is majority owned and operated by Shell. And they're also a major shareholder of a second project, Arrow Energy, where they own half that gas project as well. So from our perspective, enormous market, captive market, highly regulated, and the operators are obligated to do something about treating that wastewater. And the biggest player within that market, we've done a deal with to be able to treat that wastewater, or at least perform a feasibility study to assess the feasibility of doing that. A couple of other points to add. This is a feasibility study. It's not a pre-feasibility study. It's not a scoping study. It's not an agreement to enter into another agreement. So this is quite a way down the road. And that is because we've done a fair bit of work already in terms of piloting these wastewaters. We've generated the target products. So we have a very high level of confidence that there's a pathway to making this project work. The other element, I've got to be careful not to sort of disclose anything material, but there are opportunities to build an operation here that will address not just Shell's challenges, but industry-wide challenges. So, which is very important. So Shell being the market leader, they're the only ones who are really treating this waste brine, and then engaging us to perform a feasibility study really provides a material opportunity in its own right. But on the same note, I think the upside there is being able to genuinely deliver an issue to address a problem worth hundreds of millions of dollars a year in partnership with major companies.
I think for somebody that's not close to the process itself, it's important to understand what is being done currently, and how could Parkway's technology eventually change what the process. Because I think the buzzword here is, or the desirable target is zero liquid discharge, which is an amazing promise. I should mention. So what is currently being done? Maybe you should explain that.
Sure. So just at a high level, the general wastewater treatment flow sheet essentially involves harvesting the wastewater, harvesting the groundwater, the produced formation water, and storing that in ponds that will then undergo some sort of pre-treatment and then concentration, typically with a RO, reverse osmosis-based technology, which will reduce the volumes very significantly by more than 80% in most cases, which is great because the gas companies recover water that can be used for a range of applications. They reduce the size of the wastewater footprint. That's great. The only problem is that remaining 20% is such a large volume that it's estimated that the salt contained within those wastewater streams over the life of these projects will amount to 5.5 million tonnes. So all of a sudden, that's almost of the scale, Sven, of those salt heaps out at Castle in terms of enormous salt heaps, which is clearly a long-term issue. From a Parkway perspective, the things that are just very, very exciting about this project are that this is genuinely a zero liquid discharge. So we recover solid products that can be sold. So a lime-based product, a salt-based product that meet a technical specification. And the liquid product is actually a caustic soda, which is very valuable to industry. There's a range of industries across Australia that require caustic soda. So having a market, not just for a liquid or a solid product, but being able to produce products that are saleable is immensely valuable. So it being technically feasible, having markets for these products, as well as I think the size of the opportunity, I think is just very, very exciting. I think the challenge in the past in dealing with these wastewaters is the goal has been to produce water. And of course, if you have a very concentrated, saline, complex waste stream, that's a very, very difficult exercise. Whereas through our patented IBC technology, we've been able to demonstrate, very successful treatment of these brines, which I think is a significant opportunity. There's also, I think you could probably use this as a case study, Sven, about what's innovative about our technologies. So this particular project, the project's owned and operated by QGC, majority owned by Shell. There's a roughly $1 billion contract with Veolia, the world's largest water treatment company, to treat the waste brine that's coming from from the reverse osmosis plant to produce a more concentrated brine product. And we're essentially taking their waste brine, which is essentially untreatable by conventional wisdom, leading companies around the world. And that's the product we're taking and coming up with a permanent solution. So it really is a high value, high margin end of the value chain. And I think that's a good insight into why these things are complicated. We're taking on big challenges that are highly complex, but they're worth solving. They're very material. They provide the opportunity to generate, very significant value, which is why we've been at it for the last few years.
Okay, well, so I would imagine that Veolia is closely monitoring the progress of this feasibility, and eventually, if it turns out to be viable, they might have other ideas as well. I would imagine there's so many other opportunities out there. Can you disclose whether you are talking to a number of other mining companies with other types of water treatment issues? I know you're selling, continuously selling product to them and doing everyday work, so to speak, but I mean the disruptive technologies here.
The short answer is yes. So we have a range of different innovative technologies that we own within Parkway, and we are at various stages of evaluating, desktop evaluations, piloting, pre-feasibility studies, a whole range of studies that will follow a very similar path to this Shell opportunity. And the reason I reference that as a good case study, that's the sort of size of project, yes, caliber of partner we seek to partner with. I mean, we get inquiries all the time to work on sort of second, third tier projects, but really each of these opportunities has to be held to a very high standard. I mean, these have to be large addressable markets. There has to be a counterparty who's happy to share in some of that value creation. They have to be willing to fund some of those activities. Mm-hmm. So we're a for-profit company. So in the case of that feasibility study, we get paid for all our efforts. And it's just an amazingly exciting opportunity. I mean, a lot of your activities, Sven, of course, are in the mining industry. You're quite familiar with the scale of some of these projects. And I guess if I could sort of draw a bit of a comparison, for us as a small company, being able to capture a small share of the value of a very large mine or industrial operation has the opportunity to generate, similar value to a mid-tier miner developing a greenfield mine. These are enormous opportunities, and today we're capitalized at $25 million. So I don't want to sort of throw some random numbers out there, but some of these projects have waste streams, that are worth $50 or $100 million a year in terms of liabilities, and being able to beneficially treat those waste streams, recover some of the value, provides the opportunity to capture $5, $10, $20 million a year in essentially royalties from these projects without necessarily doing that work. So quite an ambitious agenda, but we've got a team, very driven.
No, I remember from when we talked the first time that the objective has always been to found that company based on revenue, but ultimately turn it into a royalty company, which is what you are aiming for in these big contracts ongoing, which is it's not just you sell a big plant once, but you are providing a continued benefit to your customers, and that should be rewarded by way of paying a royalty. Okay, so I think we're really keen to see even more big names, hopefully soon. And eventually, I'm just wondering when that could, also have an impact on the share price. The share price has been flat. I think you've done a really good job in raising money. I think 1 or 1.5 years ago at the pretty much at the temporary high, and you still have I think about $4.5 million cash, according to the quarterly report. And that is that enough to get you over the hump to not only maybe continuous cash flow, but eventually first, realizing the first project here of these big ones?
So quite a few questions there, Sven. So I think in terms of the capital raising a year and a half ago, almost a year and a half ago, that was very much focused on. We knew we were taking on something quite ambitious, so we're incubating a range of different technologies. We didn't have any revenues at the time, so we thought about in parallel building a revenue stream as well as advancing the technology portfolio. And I guess during that time, we haven't perhaps updated the market with every little activity, every little small project we've been awarded. We've just been focused on getting the foundations right. So during that last 12 months, 18 months, we now have 3 operating divisions in each of Darwin, Perth, Melbourne, built up teams, set up workshops, built piloting facilities. So really quite significant activity that we could perhaps market a little better. So I think that sort of feeds into market awareness. We're really at a stage now where we have key technologies reaching critical milestones. So it's easier for the market to sort of recognise what the upcoming milestones are and how significant that is. And in terms of funding, I think the last quarterly should be quite insightful for a relatively small company building multiple pilot plants, developing new technologies, operating and building plant and equipment for large energy companies, mining companies, with teams all over the place. Our net cash burn for the last quarter was $400,000 for a public company. I think that sort of speaks volumes of sort of a capital discipline in terms of how efficiently we run our business. We seek to leverage R&D grants. We seek to recover our costs from piloting type activities. So I think we can make that $4.5 million go a long way. On the same note, we're hoping to continue growing the quarterly income. So quarterly sales were just over $1.1 million in the March quarter, the last reported quarter. We've disclosed that the Shell feasibility study essentially over the next remainder of the year will net to the company in excess of $600,000. So all of a sudden we sort of start seeing a growing revenue profile that can assist in at least funding the company's operation. So at the moment we're funded for the next 6 to 12 months for business as usual. So that's very much well funded to execute what we need to execute. So the remainder of the year will very much be focused on how quickly can we advance each of these projects and continue achieving, validation for, what we're trying to do in terms of work on larger and more complex conventional water treatment applications. So we made reference to several projects, tier 1 miners in the quarterly report. So these are companies that are paying us to design, to build, deliver industrial scale water treatment plants already. So this is 12 months ago, we had no capacity to build anything. So in a short period of time, those funds we raised have enabled us to build this capability. And in time, we'll hope to be able to then incorporate our own technologies into some of these plants. So we may have built some sort of pre-concentration, reverse osmosis plant for a miner, and now they want to treat their brine stream. Well, that then provides us an opportunity to introduce our own innovative technologies. And in parallel, we'll be providing far more details about the technology part of our business. They're now at a stage where we feel more comfortable speaking about them. And just to take the CSG opportunity, for example, we didn't necessarily want to sort of keep our competitors and other people who may have, a different agenda to ourselves around what projects we're working on, what our ambitions or aspirations are, until we secure key partnerships. So I think if we look at those announcements from the beginning of this year, we knew we needed to become ISO accredited to become a supplier for Shell. So we methodically achieved that accreditation. We needed a global engineering partner to help support us in the feasibility study. We expanded our relationship with Worley to encompass the IBC technology. So all this is methodical execution. So when we've come out with, by the way, we've done a deal with Shell, that's sort of the end product of the investment we've made over the last year or two. And I think a lot of those investments, I think, will come to fruition over the next 6 to 12 months.
I look very much forward to it. It's been, I think, a really fascinating journey from since we introduced ourselves here, and I think you're on a great path. I wish you well success for the coming work, and hopefully a lot of new requests for new feasibilities, because now you have these 2 pilot plans available. You can accept and actually execute a lot more along with your partner Worley, I guess.
Well, that's right. I think in terms of, I mean, clearly the world post-COVID over the last year or two has become far more ESG conscious. So we can see it with new lithium projects. We can see the problems with producing more copper, nickel, access to water. So I think these tailwinds are only going to intensify, and it's almost impossible to permit a new mine unless you've got a whole range of, you know, very sophisticated water recycling sort of technologies implemented. And if you're an existing mine and you want to continue operating, there's a whole lot of pressures to ensure you keep investing in, you know, innovative water treatment type technologies. So we think it's a great time to be in the sector. We've been investing in it for a long time. So really looking forward to nailing some of those milestones.